Welcome to IQD Dinar News, your go-to source for the latest updates on currency exchange rates, revaluation news, and insights into the Iraqi dinar. Stay informed and ahead of the curve with our timely analysis and breaking developments. The US dollar, the euro, and the yen in the foreign exchange markets, primarily driven by investor anticipation of upcoming central bank decisions, particularly the Federal Reserve, Fed. Investors are keenly focused on the Federal Reserve's next move, which is expected to involve cutting interest rates. However, the level of uncertainty surrounding the size of the QT, whether it will be a 25 basis point bits per second reduction or a more significant 50 bits per second QT, has resulted in a softening of the US dollar. At the same time, currencies like the euro and yen have risen as traders weigh the potential outcomes of the Federal Reserve's decision. A deeper analysis of this situation reveals the multiple forces at play in global currency markets. Firstly, central banks, especially the Federal Reserve, play a critical role in influencing exchange rates and broader market sentiment. Interest rate cuts by central banks tend to weaken a currency because lower rates generally reduce the returns on investments denominated in that currency. This makes the currency less attractive to investors. In this case, the Federal Reserve is widely expected to cut interest rates, signaling a looser monetary policy that could weaken the US dollar relative to other major currencies such as the euro and the yen. Investors and traders follow central bank decisions closely because these policies directly affect the financial environment in which they operate. A key aspect of monetary policy is the setting of interest rates, which influences borrowing costs, spending, and overall economic growth. When the economy is growing too fast and inflationary pressures are building, central banks raise rates to cool things down. Conversely, when economic growth is slowing or risks are rising, central banks cut rates to stimulate the economy by making borrowing cheaper. In the case of the Federal Reserve, recent data and media reports have suggested a rate cut is all but guaranteed. The uncertainty lies in the magnitude of the QT, either 25 bits per second or 50 bits per second. A 25 bits per second cut is generally considered a more modest move that indicates caution. It would signal that the Fed is adjusting its stance but does not see the need for more aggressive action. On the other hand, a 50 bits per second cut would signal greater concern about the state of the economy, or at least a stronger desire to ensure continued economic growth. The media reports mentioned in the paragraph, such as those from the Financial Times and the Wall Street Journal, highlight the fact that the decision is not straightforward. The Federal Reserve's policymakers appear to be divided on the issue, which has kept investors in a state of uncertainty. Investors prefer clarity because it allows them to make informed decisions about their investments. When there is uncertainty, it often leads to volatility in the markets, as traders adjust their positions based on evolving expectations. One of the key data points influencing this debate is the recent report on US jobless claims, which came out higher than expected. Higher jobless claims indicate a slowing labor market, which could be a sign that the economy is weakening. This data point, combined with the Wall Street Journal article discussing the Fed's internal deliberations, has led some traders to increase their bets on a larger rate cut. As the paragraph mentions, the CME Fed Watch tool showed that the probability of a 50 bits per second cut jumped from 27% to 43% in just one day. This indicates that the market is becoming more convinced that the Fed might take more aggressive action. Despite this, the majority view still favors a 25 bits per second cut, with a 57% probability assigned to this outcome. traders are pricing in a total of 113 bits per second of rate cuts from the Fed over the remaining 3 meetings of the year, suggesting that markets expect a continued easing of monetary policy as the year progresses, shifting focus to Europe. The European Central Bank, ECB, also plays a key role in influencing global exchange rates. On the same day that this analysis was written, the ECB made a decision to lower its interest rates as well. This move, aimed at stimulating the Eurozone economy, had its own set of effects on the Euro's exchange rate. While central bank decisions are critical in driving exchange rates, they are by no means the only factor. Other elements like geopolitical risks, trade tensions, and broader economic data also play significant roles. In this case, the focus is primarily on central banks because their policies can dramatically alter market conditions. The Federal Reserve, as the central bank of the world's largest economy, holds an outsized influence on global markets, making its upcoming decision particularly impactful. When analyzing these developments from a broader perspective, it's essential to understand that exchange rates reflect the relative health and outlook of different economies. A strong currency can be a reflection of investor confidence in a country's economic prospects. For instance, a rising euro or yen in this context might suggest that traders see these currencies as safer bets compared to the dollar, especially given the uncertainty around U.S. monetary policy. This widens the interest rate differential, making the U.S. dollar less attractive. This is because investors often chase yield, meaning they prefer currencies where they can earn higher interest rates. A lower U.S. interest rate would reduce the appeal of dollar-denominated assets, prompting investors to seek better returns elsewhere, such as in euro or yen assets. However, it's also worth noting that the effects of rate cuts are not always immediate or predictable. Currency markets are notoriously complex and influenced by myriad factors. For example, if the Fed does cut rates aggressively, it could weaken the dollar in the short term, but if investors believe that this move will ultimately benefit the U.S. economy by sustaining growth, the dollar could regain strength over time. Conversely, if traders lose confidence in the Fed's ability to manage the economy effectively, the dollar could remain under pressure for an extended period. The discussion around the Federal Reserve's upcoming decision highlights the fine balance that central banks must strike. On the one hand, they need to ensure that their economies continue to grow and avoid a recession. On the other hand, they must be wary of cutting rates too much and risking inflation or creating bubbles in asset markets. This delicate balancing act is why central bank decisions are so closely watched by investors, economists, and policymakers around the world. In conclusion, the paragraph provides a snapshot of the global currency market at a moment of heightened uncertainty. With the Federal Reserve expected to cut rates, traders are left guessing about the size of the cut and its broader implications for the U.S. economy and the dollar. The rise of the euro and yen suggests that investors are seeking safer alternatives in the face of this uncertainty. Ultimately, the outcome of next week's central bank meetings will have far-reaching consequences, not just for currencies but for global markets as a whole. As always, the decisions made by central bankers will be analyzed and debated long after they are announced, as markets seek to interpret their longer-term implications. Thanks for tuning in to IQD Dinar News. Don't forget to like, share, and subscribe. For more updates on the Iraqi dinar and global currency trends, hit the notification bell so you never miss an update. See you in the next video.